Hi, I want to talk about the fundamentals of derivative products today, essentially options. I want to talk about call options and put options. Currently, options have been used by a lot of retail investors as well as institutional investors for the purpose of trading, for speculation. However, they were meant for the purpose of risk management. So, what do I want to do is I want to talk about the origin, basically address the why, that why were these products launched in the market, what was the purpose of these derivative products. And once we've understood this, we can then talk about using them from a speculator's perspective, from a trading perspective, from an investor's risk management perspective, and so on. So, I want to start off with a small story in order to contextualize and explain the purpose of these products. Uh, Let's assume that you are an oil refiner, right? For an oil refinery, crude oil happens to be raw material, right? And every refiner faces this risk that crude oil prices could increase, and if raw material prices go up, obviously profit margins tend to shrink. All right, let me write this down. Let's assume that you are a Reliance Industries 20 years ago, which was a pure play a pure play refiner, right? It wasn't into extraction of crude oil and only into refinement of crude oil, right? So, let's say you were RIL and you faced this risk that crude oil price could increase, all right. Essentially, crude oil happens to be raw material for the refiner, right. Let's assume that spot price of crude oil right now is $60 a barrel, right. And let's assume that for the next quarter, the company expects that crude oil prices are going to climb up to, let's say, $75, $80. So, there is this inherent risk that the raw material prices could go up, right. Now, what can a refiner do? Usually a refiner will get into forward contracts, right. So, Reliance will get in touch with an exploration company which is into crude oil exploration, extraction of crude oil, and say, hey, can we lock in a forward contract? So, can I buy some crude oil from you at a particular price, a particular quantity, which I am willing to commit to right now? We will execute it in the next quarter or over the next quarter. So, the typical risk management technique is to get into a forward purchase contract, all right. Let's say they get into a forward purchase contract at $75, all right, a barrel. Now, this ensures that if crude prices at the end of the quarter or throughout the quarter are $80 a barrel, the refiner will still be able to procure the raw material at only $75 a barrel. So, you have been able to cap, there is a ceiling beyond which Reliance will not have to pay for buying oil, right. So, the product serves its purpose. However, here's this bit with a forward contract, the limitation is that if crude prices do not go up, let's say over the next quarter crude prices from $60 a barrel only go up to $65, $68, right. Then you are stuck executing this contract at $75 a barrel, you can't back out, right. And hence, the limitation of a forward contract is you have to commit X quantity at Y price and you can't back out, right. Now, this is where let us assume if an angel walks in and writes the following for the refiner or Reliance, that I promise. So, let us say I write on a piece of paper, right, that I promise to sell crude oil at $75 a barrel if you may want to purchase X barrels in the next 3 months. Let us say this is signed by me, right. Let us say I walk into this deal and I say, hey, go ahead and feel free to buy from me at 75 a barrel. If you notice, I have used the word you may. I have not said that you will have to buy. So, as a refiner, you find this to be an amazing contract saying that, hey, I do not have somebody putting a gun on my forehead saying that I will have to buy at 75. So, let us just assume that if crude oil prices go up to $80 a barrel, you can walk up to me and buy oil from me at 75. So, you are in the money by $5 a barrel. You are able to buy from me at a lower price in spite of the fact that market prices are hovering around 80, right. However, since I have written you may, let us just assume that market prices of crude oil in the next quarter is at $65 a barrel. You will say, I will not buy from you at 75, I will go out in the open market and buy oil from the open market at 65. So, you do not have to forcibly buy from me at the committed price of 75, right. Does not that look to be an awesome deal for Reliance as a company? Because what you have done is you have protected yourself from the risk that crude prices could go up, but you have also kept the ability to buy at a lower price from the market, because what I have written in the contract is you can, you may, not that you have to, right. Now, this is what I call as a call option, all right. A call option is essentially a product where Reliance can call for crude oil at $75 a barrel, but is not forced to buy from me, right. So, what does a call option give Reliance? It gives it the right to buy oil at $75 a barrel. In other words, the word right means you are not obliged to buy from me, but what do you have is the right to buy. However, I, as the person who has signed this contract, I have an obligation. If you come up and exercise your right to buy from me, I can't say no. I will be obliged to sell because I am the writer or the seller of the call, all right. So, what do I have? I have an obligation to deliver oil, obligation to sell oil. As against that, you, if you are Reliance, if you are the refiner, what do you have? You have the right to buy oil. So, please understand, if I were to define what is a call option, the product is made for you because you have an upper hand clearly. I do not have an upper hand as a writer because I am only having an obligation to sell crude oil, whereas what do you have is a right. So, this product is made for you, all right, it is not made for me. I am somebody who is providing services to you. I am laying down this red carpet for you saying, hey, come and buy from me at any point of time at a price of 75, right. Obviously, for the service that I am giving you, you will have to pay me something, right, because I have taken away from you your risk the risk that crude oil prices could go up is no longer there. Why? Because you can buy oil at 75. If the price of crude oil is above 75, you will exercise your right to buy from me. But if oil is trading below 75, you will not exercise your right to buy from me, and you will go out and buy at the market price. So, the risk that the market price could go up is managed. At the same point of time, you can go out and buy oil if prices actually tend to go down. And that is where the word option comes in, that you have the option to come to me or you have the option to go out. That is why if I were to probably define a call option, it is a product which gives somebody the right to buy the underlying asset. The underlying asset in our case is oil. That underlying asset could be a commodity oil, it could be a stock. The right to buy a stock from me, the right to buy let us say currency from me. So, the underlying could be the fact that you have the right to buy dollars from me, or the right to buy an Infosys share from me, or the right to buy a commodity like oil. And hence, an option product could have several underlying assets. It could be a commodity which is an underlying asset, it could be a stock which is an underlying asset, it could be a currency which is an underlying asset. For starters, that is more than enough to understand as an underlying asset. The $75 that we spoke about is known as the strike price of the call option, alright. So, it is the price at which we struck the deal, right. You have the right to buy this from me at a strike price of $75, and that is where the word comes in, strike price. And the last bit, whether you will come to me or not, as the writer of the call option, I am providing services to you, and hence I deserve some payment, right. I am not sure that over the next 3 months whether you will exercise the call or you will not exercise the call. So, I am going to ask for this payment upfront, which is known as the premium on a call option. So, the premium on the call option is an expense for you, the refiner, and it is an income for me, the writer of the call, right. So, that premium could be, let us say, $5 a barrel, alright. Premium is, as I said, for the seller of the call an income, and for the buyer of the call, the buyer of the call option pays premium, and the writer or the seller of the call receives premium. That is what basically explains why am I doing it. I am doing it because I get some fixed income out of it. You are doing it because you can manage your risk. At the same point of time, you have the option to go out and buy at a lower price. If crude oil prices on maturity are below the strike price, you will not come to me, right. So, I hope this explains the origin of call option as a product, and I hope you have been able to understand that there are two parties to it. One, who is known as the buyer of the call, that is the refiner. Second, I am the writer, also known as the seller of the call. The seller of the call is at a disadvantageous position because I have an obligation to sell. I can't say no to you if you exercise your right to buy from me, alright. You obviously are at an advantage because you have a right, you do not have an obligation. For that, the advantage that you have, for that you are going to be paying a premium to me. So, premium is your expense and premium happens to be an income for me, right. So, now we will get on to numericals, trying to know the payoff, what are the risk and rewards attached, etc., for a call option. But this is the basic understanding of a call option, a product designed for managing risk of the underlying prices going up. I hope that helps. Thank you. So, now that we have discussed the characteristics of a call option, now that we know that call option is essentially meant for managing risk, what kind of risk are you trying to manage? The fact that your underlying asset prices could shoot up, that can be managed by a call option. What do I also want to show are what are the payoffs, the cash flows associated with a call option if you use a call option not for a risk management perspective, but for a trading perspective, or I would not call it exactly speculation, but yes, from a trading or a speculative purpose, how do the cash flows and the payoffs of a call option look like. So, let us assume this that we have a call option and you have taken a position, right. We know that there are two positions, you could either buy a call or you could either sell or write a call. In finance terms, this is known as a long or a short position. So, when I am saying you have taken a long position in a call option, essentially who are you? You are the buyer of a call. And now we know that the buyer of the call has the right to buy the underlying asset for an agreed price. That agreed price is known as the strike price. So, what did you do? You called up your broker on the terminal, you said, hey, I want to buy a call option. What is the underlying asset? Let us assume that the underlying asset is not crude oil, let us assume it is a stock to make it more relatable, right. So, let us assume you bought a call option on a particular stock, which has a strike price of 200 rupees and which involves a premium of 20 rupees. So, this option gives you the right to buy the underlying asset, the stock, at 200 rupees, and you will have to pay a premium of 20 rupees to buy this option. This should be now clear that the buyer of the call pays premium, and the opposite party to this, that is the writer or the seller of the call, will receive 20 rupees. So, when I am saying that I want a payoff table on maturity, right, I am saying that this call option, let us say, has a maturity of 1 month, 2 months, 3 months, and what will happen to the stock price after 1 month or after 2 months or after 3 months, essentially what will happen on maturity. So, on maturity your prices could go up or it could go down. I am going to make a set of assumptions that what are my stock prices on maturity, right. So, let us assume that stock prices have either gone up or gone down, right. So, I have given you an entire array from 140 to 280 to 300. That is an entire array, and these are assumptions that let us assume that stock prices they plummet down to 140 rupees or they go up to 300 rupees. Under this, what is the decision making and what is the behavior of the buyer of the call? So, how does the buyer of the call behave if the stock price is at 140 or if the stock price is at 300 when the call option matures, right. So, I am going to say that I have a right to buy at 200. Will I exercise or not exercise my call option? It is a very clear not exercise for me, because I have the right to buy the stock at 200 rupees from the writer of the option, but this stock is available in the market at 140. So, why in the world should I exercise my right to buy from the third party? I will not, right. In the extreme case over here, if the market price is 300, I will exercise my right to buy at 200 because it makes sense, right. I want to buy at a cheaper price. I do not want to go out in the market and buy at 300. I want to buy at the strike price of 200. So, I hope the decision making is clear. When does the buyer of the call exercise the call option and when does he not, right. If market prices go up, he or she will exercise the call option because you have the right to buy at 200, and if market prices are beyond 200, it makes sense. So, you will notice that for all market prices that I have written beyond 200, the decision is very clear, exercise. But for all market prices which are at or below 200, I have said not exercise. Like we can talk about exact 200, maybe I am indifferent. It does not make sense whether I buy from the seller of the call or whether I go out in the market. So, I can also type an indifferent over here, or the decision is still not exercise. Are we clear with the decision making, right? Now, let us talk about the cash flows. Any which ways, do we realize that the premium will be paid by the buyer of the call, because the buyer of the call gets the right. So, the other party is taking the obligation, providing me the services. He or she needs to be rewarded for the services, and hence premium is an income for them. For us who are the buyer of the call, premium is a cash outflow, it is an expense. So, irrespective of the decision that I take, right, 20 rupees is a cash outflow, it is an expense, and hence I have written this as, let me just zoom in there, it is a minus 20, a minus 20 essentially shows that it is a cash outflow. Fair enough? Now, let us talk about the gross payoff. When the market price is 140 and I have a right to buy this product at 200, right, obviously the gross payoff is 0, because I do not take, I mean, think of this, that I have a product, a call option, which gives me the right to buy at 200 and the product is trading in the market at 140. Can I just tear this option and discard it, because I did not get an advantage out of it? My right to buy at 200 is worth nothing, because the damn product, this underlying stock, is available in the market at 140 on maturity, and hence all that I did was I ended up losing 20 rupees as premium. I made a net loss of 20 rupees, right. However, if I go to the other extreme of 300, that is when my call option really gets me to think that, you know, I've really made a deal out of it. Essentially because I have the right to buy this product from the seller of the call, from the writer of the call at 200 rupees, when the product is actually trading, this stock is trading in the market at 300, right. So, I will make a gross profit of 100. Where did this 100 come from? It is the difference between this 300, let me highlight that with a different color, between this 300 and my strike price of 200, right. I am saying I will buy this from the writer of the call at 200 rupees, the underlying asset which is the stock, and go out and sell this asset, this stock in the open market at 300, and hence I will make 100 rupees per stock, right, minus 20, the net payoff that I make is an 80, right. So, whenever I exercise the call, I am going to make some money out of it. When I do not exercise the call, the reason I do not exercise it is I see my money going down the drain, and the max that can go down the drain is 20 rupees. I cannot make a loss which is more than 20, which is equal to the premium paid, right. And hence in all these cases you will notice every time that I have written not exercise, the maximum that I make in terms of a loss is 20, all right. However, if the market price is 220, I am saying the difference between 220 and the strike price of 200, I will exercise my right to buy at 200, sell the stock in the market at 220, make a gross profit of 20, premium paid of 20 earlier. So, I make a net profit which is 0, that is my break even point. Anything beyond 220, when market prices go beyond my break even of 220, I start making more money through the call. So, my payoff is then 20, 40, 60, 80. Now, think of it, how much can I make out of this call? From a textbook theoretical point of view, my profit potential is unlimited, because my stock prices could be at 3000 also, right? Not only 300. Technically, the market price could go up to infinity, right? And hence my right to buy 200 becomes really valuable, because then I can sell at a very high market value, right? So, if I were to plot this in terms of the payoff matrix of the buyer of a call, right? The buyer of the call has a limited loss potential, and what is that limited loss? The loss cannot be more than 20, right? And what is the profit? The profit could be infinite, it could go up to anything. When do I make money? When the underlying asset prices are moving up, right? When do I make a loss? When the underlying market prices are going down. So, think of it, is a call option a bullish product or a bearish product? When does it work? When markets go up or when markets go down? For the buyer of the call, the product works when markets go up, and hence if I were to show you the payoff for the buyer of a call, the payoff looks like this, all right. I'm saying that the position is a long call. A long call position means buyer of a call. It's a limited loss potential. Limited loss means, mark this, minus 20. So, when market prices were 50, 100, 150, 200, I was making a loss equal to 20. The reason I was making a loss equal to 20 is I was not exercising my call option, and hence the premium that I paid on the call went down the drain. But as market prices went beyond the break even point of 200, I started recovering my premium and I started into a net profit. This comes to what? This is equal to $80, the profit that I make when the market price was 300, exactly what we calculated over here. When the market price went up to 300, I ended up making a profit of 80, right. So, I hope this payoff diagram helps. The graph helps in terms of putting out the position of a call option very clearly. It has an unlimited profit and a limited loss potential, and it's a bullish product, right. That summarizes the position on a call for the buyer of the call, not for the seller or the writer of the call. That's a different discussion altogether, but the product is made for the buyer and it's a bullish product. Those are your key takeaways, that limited loss, you can't make a loss more than the premium paid, profit potential is unlimited, and the profit kicks in when underlying market prices tend to go up, which makes a call option a bullish product. Thank you.